Greetings, everybody. Welcome to the Liberty Call. Today is Thursday, January 4th, 2024. Hope everybody's having a great day out there. You can see my good buddy Jake back here. He's hiding behind the printer because he wants to go out and play. It's been cold all day. I haven't taken him out a whole lot. So as soon as we're done here, we're going down for some ball time. So anyway, today we got market recap, got some job reports, and we're going to go through the Fed minutes that came out yesterday. So super exciting. So if you need something to help you fall asleep later tonight, save this video. Anyways, all right, if it is your first time here at the Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. God, my beard's sticking out sideways, even after I combed it. Anyways, all right, let's go ahead and get into today's numbers and see how they turned out. Everything looks like it fell apart at the end of the day. The Dow Jones was up 0.03%, 10 points, closed at 37,440. S&P 500 down 0.29%, closed at 4691. NASDAQ down 0.56%, closed at 14,510. And those indexes were in the green all day. I'm a little surprised that they lost their momentum. The VIX was up 0.64%. It's at 1413 right now. Canada was up 0.25%. Brazil down 1.14%. And Mexico down 0.54%. Over in Europe, Germany was up 0.48%. UK up 0.53%. France up 0.52%. Netherlands up 0.07%. Spain up 1.28%. Italy up 1.01%. Switzerland up 0.48%. And Portugal up 1.18%. Russian exchanges both green. MOEX up 1.19%. RTSI up 0.84%. And the overnights, the Nikkei in Japan was finally open, down 0.56%. Australia down 0.39%. New Zealand up 0.3%. In China, the Shanghai was down 0.43%. The Shenzhen Component down 1.24%. China A50 down 0.88%. DJ Shanghai down 2/3%. Hang Seng down 0.08%. And the Taiwan weighted looks like it was closed. All right. So that's everything there as far as the markets. Like I said, little surprised that they kind of fell apart later in the day. I mean, the Dow was up like 200 points early, at least the morning. So anyways, all right, let's jump over to the market recap. S&P Dow first up day, well, that didn't happen, of 2024 on financials and strong jobs data. All right, after a sluggish start to 2024, the S&P 500 and the Dow Industrial showed signs of recovery, marking their first positive sessions of the year until it closed. Financial stocks and robust job data contributed to the positive sentiment, prompting investors to reconsider the timing of potential interest rate cuts. The initial days of the year witnessed profit-taking and the S&P 500's worst two-day performance since October, following a strong rally in 2023. Speculation regarding Federal Reserve rate cuts had driven much of the market activity towards the end of the previous year, but the minutes from the December policy meeting offered limited clarity on the timeline for easing measures. Traders currently estimate a 66.4% chance of at least a 25 basis point rate cut in March and nearly a 93% probability for May, according to the CME's Group FedWatch tool. The financial sector led gains among the S&P 500 sectors with a 0.8% rise. Allstate reached an all-time high, rising 3.4% after Morgan Stanley upgraded its rating on the insurer to overweight. Other insurers, including American International Group and Hartford Financial Services Group, also saw increases. Banks performed strongly ahead of the upcoming earnings season, with JP Morgan Chase hitting a record high and Truist Financial advancing after a ratings upgrade. The ADP National Employment Report revealed that U.S. private employers added more workers than expected in December, indicating ongoing strength in the labor market. Private payrolls increased by 164,000, exceeding the previous month's rise. Despite a positive tone, most S&P sectors experienced declines, with energy leading the losses after a substantial U.S. fuel inventory build pushed crude prices lower. Apple shares slid after a downgrade, while Merck gained after an upgrade. And Mobileye Global and Walgreens Boots faced declines following their respective financial announcements. So it's kind of a good and bad situation today. All right, let's go a little deeper into the job stuff. Weekly U.S. jobs claims fall to 2-month low. Labor market steadily cooling. All righty, the number of Americans filing new claims for unemployment benefits fell to a 2-month low, reaching 202,000 in the week ending December 30th, reflecting sustained strength in the labor market, even amid easing demand for workers. They keep saying easing of the demand, but these numbers still look fairly strong. So I guess they're hoping to wish it into existence by typing it week after week. The decline suggests underlying labor market resilience, reinforcing expectations in financial markets that the Federal Reserve may initiate interest rate cuts in March. Although job openings had recently dropped to a near 3-year low, the labor market's robustness is anticipated to shield the economy from recession in 2024. And if you watch the last 2 days, we covered articles from First Trust Financial on why we're going to have a recession. So, all right, where were we? I moved forward too far. All right, there we are. The labor market is currently in a balanced state, not too hot nor too cold, with the total number of Americans on jobless rolls remaining elevated compared to the prior year. However, the level of unemployment is insufficient to signal a downward slope towards a recession. Initial claims for state unemployment benefits decreased by 18,000, reaching the lowest level since mid-October. The claims data, while subject to volatility during the holiday season, have generally fluctuated within the lower end of their range for 2023. And if I could pause here again, typically employers don't lay off people when things are still going okay. They're going to wait until things start to kind of, the poop hits the fan, like an airplane. And, so they're not going to just, especially with, the trouble with getting quality workers in this environment. I'm sorry, millennials and Zoomers, y'all are idiots and bad employees. But that's just the situation. So I wouldn't really look at the jobs numbers to indicate whether or not we're heading into recession. I'd look at, the financials that will be coming from the earnings season here coming up, see how companies are doing as far as their profit and losses. That'll give you a better sign of, are these companies, heading into the toilet, or are they going in a positive direction? So, all right, let's jump back in with 525 basis points. That's 5.25% for the rest of us, worth of interest rate hikes by the Federal Reserve since March of 22. The labor market is cooling, but the unemployment rate remains below 4%. The resilience of the labor market bodes well for consumption and the overall economy. Stock markets responded positively to the news, trading higher, while the dollar fell against a basket of currencies and U.S. Treasury yields rose. Job cuts announced by U.S.-based employers dropped 24% to 34,817 in December, according to a report by global outplacement firm Challenger Gray and Christmas. The report also noted that planned layoffs increased by 98% to 721,677 in 2023, the highest annual count since 2020. Despite concerns, financial markets are betting on the Fed initiating interest rate cuts in March, as indicated in the recent minutes of the central bank's December policy meeting. The minutes suggested that the labor market remains tight, but is gradually coming into better balance. All right. And that actually leads us right into our last subject here, the Fed meeting minutes. Dun, dun, dun. Should have like some little explosions. All right, so we're going to go through all the sections here. I think there were 4 or 5 of them, if I remember. So we'll go ahead and start out with the developments in the financial markets and open market operations. All right, during the intermeeting period, the Federal Reserve observed easing financial conditions marked by a decline in interest rates, increased equity prices, and a depreciation in the dollar. The rise in equity prices was supported by declining Treasury yields and robust earnings growth, surpassing consensus expectations. Implied volatility for equities notably decreased, meaning the market wasn't so jumping around, reversing some of the tightening seen over the summer and fall. Yields on nominal Treasury securities, particularly longer maturities, sharply declined as investors perceived reduced risks of prolonged inflation pressures, interpreting incoming data accordingly. The shift was further solidified by market expectations that the committee's policy rate had reached its peak. The Treasury Department's indication of shorter dated maturities in Treasury securities issuance also influenced the market. Models attributed about 2/3 of the decline in long-term yields to a reduction in term premiums and 1/3 to a decrease in expectations for the policy rate. Survey responses indicated a consensus among primary dealers and market participants that the peak federal funds rate for this tightening cycle had been reached. Market pricing suggested a considerable downward shift in the average path for the policy rate, with expectations for the first rate reduction in June. In money markets, the use of overnight reverse repurchase agreement on RRP facility continued to decrease, primarily due to lower participation by money market mutual funds. Private market repo rates were expected to remain above the on-RRP rate, inducing a reduction in the facility usage. Respondents adjusted expectations for on-RRP balances and raised expectations for reserve balances, with no sign of pressures evident in aggregate reserves across the banking system. The Federal Reserve will continue monitoring various indicators of money market conditions for effective market surveillance. The committee unanimously ratified the desk's domestic transactions with no intervention operations in foreign currencies during the period. All right, staff review of the economic situation. At the December 12th, 13th meeting, the Federal Reserve assessed economic conditions, observing a slowing growth rate in U.S. real GDP from its robust third quarter pace. The labor market remained tight with continued though moderating job gains and a low unemployment rate of 3.7% in November. Labor demand and supply were gradually aligning, evident in slower non-farm payroll expansion, unchanged unemployment rates, and a flat labor force participation rate. Consumer price inflation, while still elevated, showed signs of easing, with the price index for personal consumption expenditures, the PCE, at 3% and core PCE at 3.5% over the last 12 months, ending in October. Real GDP growth slowdown was noted, with consumer spending growth decelerating in October, and business investment indicators showed mixed results. Housing starts remained flat, manufacturing production declined, and the trade deficit widened in October. Foreign economic growth impacted by tightening global monetary policy and last year's energy shock in Europe contributed to subdued growth, notably in China. Inflation concerns in major economies, although still elevated, showed marked decreases driven by declines in energy and core inflation amid slowing demand and falling oil prices. I believe I said that like a year and a half ago, is that we're going to experience inflation problems as long as energy is expensive, because if energy affects everything from the light right there on my desk to driving your food across the country to everything else. All right. Most major foreign central banks maintained unchanged policy rates, emphasizing the need for a sufficiently restrictive stance to achieve inflation targets. All right, staff review of the financial situation. Over the intermeeting period, softer than expected economic data and perceived signals of less restrictive monetary policy influenced financial markets. Investors revised expectations for further rate hikes down, causing a significant decline in nominal Treasury yields. The anticipated market implied path for federal funds rate shifted lower, reaching 25 basis points below the current level of the May 2024 FOMC meeting. This was 2 meetings earlier than previously expected. Market sentiment improved, leading to a notable rise in broad equity indexes and a narrowing of credit spreads on investment grade and speculative grade corporate bonds. The decline in U.S. yields below forecast global inflation and falling oil prices contributed to substantial decreases in foreign yields. This improvement in market sentiment extended globally, with increased foreign equity prices, narrowed credit spreads, and slowed outflows from funds investing in emerging market economies. As a result, the U.S. dollar depreciated broadly. U.S. short-term funding markets remained stable, with continued decline in the usage of the overnight reverse repurchase agreement, the on-RRP facility. The decline was primarily driven by money market mutual funds reallocating assets to Treasury bills and private market repo. Borrowing costs for businesses, households, and municipalities decreased, reflecting lower, longer maturity Treasury yields and narrower credit spreads, although borrowing costs remained elevated. Bank credit conditions appeared to tighten slightly, with contraction on commercial and industrial loan balances and a moderation in commercial real estate loan expansion. Consumer credit flows softened, particularly in credit card balances, and credit conditions for small businesses tightened further. Credit quality remained broadly solid, but delinquency rates rose in some sectors, such as non-farm, non-residential CRE loans and small business loans, signaling increased stress. Staff economic outlook. The economic forecast presented by the December meeting remained consistent with the prior projection, anticipating a marked slowdown in the fourth quarter GDP from the robust third quarter pace. Despite the near-term moderation, economic growth for 2023 was expected to be solid. The lagged impacts of previous monetary policy measures contributed to persistent tight financial and credit conditions were foreseen to exert a more pronounced restraint on economic activity in the coming years. Real GDP was projected to increase more slowly than the staff's estimate of potential in the next 2 years before aligning with potential growth in 2026. That's 2 years from now, folks. The unemployment rate was anticipated to remain relatively stable through 2026, balancing the effects of below potential output growth and improvements in labor market functioning. The staff revised down their inflation forecast, reflecting recent lower than expected data and a belief that inflation would be less persistent than previously estimated. The total PCE price inflation was expected to be somewhat below 3% in the current year, with core PCE price inflation slightly above 3%. Inflation was projected to decline in the following years as demand and supply in product and labor markets better aligned, with total and core PCE price inflation reaching close to 2% by 2026. So again, we still got a ways to go, folks. While the staff acknowledged elevated uncertainty in baseline projection, they noted a reduction in volatility of incoming data and forecast errors over the past year. Risks around inflation forecasts were seen as tilted to the upside, considering the persistently elevated inflation and the potential for it to be more enduring than expected. We've been experiencing that. Conversely, risks to the economic activity forecast were viewed as leaning to the downside, particularly due to the potential for additional monetary policy tightening in response to the elevated inflation risks, which could result in greater tightening of financial conditions and impact economic activity adversely. All right, the participants' views on current conditions and the economic outlook. During the December FOMC meeting, participants submitted their economic projections for 23 through 2026. Despite stronger than expected third quarter GDP, recent indicators suggested a slowdown in economic activity. While job gains moderated, they remained robust and the unemployment rate stayed low. Inflation had eased over the past year but remained elevated. Participants generally expected real GDP growth to cool in 2024 with a rise in the unemployment rate. Inflation projections for 2023 were revised down based on the better than expected data. Participants judged the current policy stance as restrictive, affecting economic activity and inflation, with risks becoming more balanced. Despite financial conditions easing, participants committed to the 2% inflation goal, emphasizing the need for further evidence of sustained inflation reduction. They recognized progress in reducing inflation and attributed it to supply chain normalization, improved labor supply, and restrictive monetary policy. Participants acknowledged uncertainties in the economic outlook and the possibility of extended restrictive policy, meaning keeping interest rates high for longer. They discussed household credit usage and a mixed business sector outlook and importance of data-dependent approach to monetary policy, meaning that they're not doing anything until they see, hard data in front of them that, things are getting better. So again, just the hope that it'll get better. They're not going to, move rates. All participants agreed to maintain the federal funds rate target at a 5.25% to 5.5% with ongoing balance sheet reduction. The policy rate was viewed as its near peak for the cycle, reflecting the decline in inflation and a better balance in product and labor markets. Participants submitted projections implying a lower target range by the end of 2024, but elevated uncertainty suggesting the need for cautious data-dependent approach. Risk management considerations included diminishing upside inflation risks and the potential trade-off between dual mandate goals. The ongoing balance sheet reduction was considered integral, with discussions on technical factors for slowing the pace well in advance. And the committee policy actions. So this is what they decided to do. During the recent monetary policy meeting, the members of the Federal Reserve acknowledged a deceleration in economic activity post the robust third quarter. Although job gains moderated, they remained robust and the unemployment rate stayed low. Inflation, while having eased over the past year, remained at elevated levels. Members concurred of the soundness and resilience of the U.S. banking system. They recognized the potential impact of tighter financial and credit conditions on the economic activity, hiring, and inflation, albeit with uncertain extent. To support the committee's objective of achieving maximum employment and 2% inflation over the longer run, members decided to maintain the federal funds rate at the 5.25% to 5.5%. The committee committed to ongoing assessments of additional information and its implications for monetary policy. Members agreed to consider the cumulative tightening of monetary policy, lags in its effects, and the economic and financial developments in determining the extent of any further policy firming needed to return inflation to that 2% target. The decision also included a commitment to continue reducing the Federal Reserve's holdings of Treasury securities and agency debt and agency mortgage-backed securities. In their post-meeting statement, members acknowledged the economic slowdown from the robust third quarter pace and the persistence of elevated, it's more of just a more of the same. They kind of like to repeat all the same stuff over and over and over again. All right. So all of that, they didn't raise rates. They left them where they were. So that, 10 minutes worth of jabbering. And I mean, this is a summary. I mean, if I read it word for word, you'd probably take it half hour. So, but all that being said, they decided to leave rates where they were, which we already talked about last month when the decision came out. And, they're going to use a data-driven approach to decide whether or not or when they're going to lower rates and to get back to that 2% target. So I know everyone in the financial journalists and the talking morons on TV have been, we got to lower rates, we got to lower rates, we got to lower rates. But they've been saying that for a year now. So, I mean, the economy hasn't fallen apart yet. I think it'll probably, once the yield curve probably starts to normalize, people will feel better. And then, the train will go off the tracks at that point. So anyways, all right. Well, that's everything I had for today. Again, if you need help falling asleep, this is probably the episode you might want to save. So, save that in your podcatchers or your YouTube account. So, all right. Well, again, that's everything that I had for today. If you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.